Alright. My questions, I want to repeat one more time. What are those elements on balance sheet? Once we know what are those three major elements on the balance sheet, then you will never forget for your whole life, okay, what balance sheet is for. Alright? So I believe Joyce just mentioned it. There are three major elements on the balance sheet. One more time, everybody, on this side. This side is quite very, yes, Eugene.
Asset.
Assets, number one.
Liability.
Liability, number two.
Equity.
Equity, number three. Alright? So this is can I erase this? I need more space. I can erase this, right? Say this is ABC company or ABC business whatsoever. Okay. Alright? We have assets here. We have a liability here. Then we have equity. In the bottom line, this number equal to this number. Okay. This is the format. Okay, the format of the basic balance sheet. Doesn't matter how small or how large, how big the business is. They are all the same. This is the structure. Okay. And then if you have your book, okay, then you can check the example here. Or for I don't know how many. I believe there are 5,000 public trading company in the United States. I assume probably that's the correct number. You pick anyone. Okay, Apple, Cisco, Microsoft. You just go to their website. Okay, after this class, you just go to their website. There's one icon, must be there. It's called public relationship, PR. Under that icon, you can find out the update annual financial statement. It is required by law. They must provide it. The only difference is for each company, they have different fiscal year, basic fiscal year or business year. Not necessarily ended by December 31st. Each company, they pick their own tax year or fiscal year whatsoever. However, they have to provide the update financial statement. So, you know, if you really want to, this is not homework assignment, but if you really want to, after this or during the lunch break, you have internet access, try to go to internet, pick out any company you like. As long as they are public trading company, they must provide one icon say public relationship. Under there, you can find out financial statement, and you just see balance sheet. Just take a look of their balance sheet. So it doesn't matter how big the company is. Okay, multiple billion-dollar company. You will see this is a structure: assets, liability, equity, and the bottom line here. Those two numbers must be equal. Must be equal. So in the future or for this class, we will always say, okay, we will always say this is the formula. Okay, okay. A stand for assets equal to L mean liability plus E. Okay, to simplify the whole formula. Okay, one more time. When we talk about balance sheet, the basic idea is that A equal to L plus E. But you need to memorize A mean assets, L mean liability, alright? E mean equity. So you have this in your concept and you will never forget for your whole life. I know the difficulty is, okay, it is not very tough for everybody to say A equal to L plus E. I think this is nothing, right? However, I know the difficulty is you need to learn what kind of item or what kind of accounts, we say accounts, belong to which category. Say for example, cash. Doesn't matter how large, how small your business is. So for example, you just start out your own business and you just deposit, say, $200 cash to your bank in order to open your business checking account, right? You just deposit $200 into this new account. So right now, say under the ABC Corporation, you can see your financial statement already. At this moment, you see it already, right? You have cash, $200. But I will ask you, cash belong to which one? Cash. I'm talking about cash, okay? Cash belong to this assets. We'll learn this, okay? Assets mean something valuable belong to you, something valuable. All right. So as I said, you just transfer $200 cash from your own personal account, or you just write a check $200 from your, say, Samuelton account to your ABC new business account, right? So right now, at this moment, you know your business right now own $200 cash in your checking account, right? So cash is assets. Another thing like inventory is assets. Real estate property is assets. Equipment, say desk, chairs, computers, they are all assets, alright? Another thing is account receivable, right? Can anybody tell me what is account receivable? What is account receivable? By the way, for small business, probably there's no account receivable. Assuming everything you sell, you collect cash, then for this type of business, you don't have account receivable. But can anybody tell me what is account receivable?
You know, a company, you sell something, but some company will pay you daily.
Yeah,
30
that
days.
is very common practice, right? If you are a trading company, you get something in, eventually you don't pay right away. You ask your vendor, say, can you give me 30 days payment, right? Same thing, when you resell to your customer, maybe as long as there's not retail. Okay, if it's for retail, usually you collect the money. But if you are like, like a wholesaler, distributor, when you sell something to another merchant, usually they don't pay you cash. So when you sell something, you ship your merchandise out. However, you don't collect the money right away, and that becomes account receivable. Account receivable is assets. No problem, right? So far, I'm talking about what kind of item belong to assets, right? Go back to my example. Okay, my example is right here. Say the day one, you open up your business, all right? You just transfer your $200 from your personal checking account. You write a check, transfer to this newly set business checking account. So $200 from your personal to your business. So right now, we know under your ABC company, you have $200 cash, right? Don't forget, right? Those two numbers must be equal, right? So you have 200 here. Then, in our accounting, okay, there's one theory. Okay. The theory is for each transaction, or we say for each event, whenever this one thing happens, this event will affect minimum 2 accounts. Okay? Minimum affect 2 accounts. So right now we know you transfer $200 from your personal to your business. We know business received $200 cash. So we know cash account increase $200. Then you need to think about that. Okay, for each transaction there must be at least 2 accounts being affected. So right now I have 1 asset. Then you need to think about that. Even without any accounting concept, without any accounting knowledge, can you tell me what is the other account could be affected? Go ahead.
I have a question.
Yes, go ahead.
Really a question about this account receivable. Like for example, I return my goods and you don't get the money.
Okay, we will cover account receivable later on because there's one chapter we talk about sales. So I will just leave it alone because for this basic, for today, I just want to give you a very simple introduction. And down the road, even though this semester is so short, but I believe we have such opportunity to go into each items here. So I will go back to your questions probably a few weeks later. But go back to my questions, okay? I say, you just transfer $200 from personal to a business. So right now we know business received $200. However, tell me, even without any accounting basic knowledge, just give me the wild guess. Okay, which item may be affected?
Equity.
Yeah. So for those people you don't answer it, but I believe makes sense, right? When your company receive 200 here, so it's 200 here. So you think about it, wow, this must be another number should be there to make this equation happen, right? 200 equal to another 200, right? Equal to another 200. So must be 200 here, right? And that 200 is equity. So right now we understand what equity is. Equity really means the ownership interest. The ownership interest. So makes sense, right? Because this $200 is still yours. Still yours. The only difference is 200 from your personal account transfer to your business account. So for accounting purposes, this $200 is under different bookkeeping. Before you have your business, $200 belong to your personal. But right now, $200 still yours, but it is under your business. So you have a 200 here, cash. You have another 200 here, equity. That really means this $200 belong to the owner of this business. And who's the owner? And we will talk about that in September, right? So if this business is sole proprietorship, you are the only one owner. If partner, maybe 2 or 3. If corporation, shareholder. If LLC, we say the owner, the name of the owner is called members. Is called member. All right. So we settle, right? Yes, Eugene.
Dr. Tong, this balance sheet is for business, right?
Right.
Then this equation is for business,
That's
right?
correct, right?
But how about your personal account?
Okay.
Do you want to write another equation? I want to
Yeah,
see.
very good questions. Okay, very good questions. Okay, let's go back to our fundamental issue, right? For this course, we say financial accounting, right? So even for your personal, you may think about to have your accounting. Well, at least for your management purposes, you want to make sure how much money you earn and how much money you spend, and by the end of the month, at least you want to see the balance. You don't want to overdraft, otherwise you have trouble, I mean, they kind of know it to defense your debt issue. Hopefully you will not go into that situation. So at least one reason you want to keep your personal financial statement is to oversee or to supervise, to making sure to manage your personal financial situation at least by the end of the period is balanced. You don't want to overspend, and hopefully you can save something for the future days, right? So this is a very good question. And right now we are talking about for business. For personal, okay? The answer for Eugene's questions, oh by the way, you all know his questions? Before I give you the answer, okay? His questions is, what about your personal?
Personal,
Can we apply?
You don't have stock. You don't issue stock. Why personal?
Very good, very good. So Eugene's question is, can we apply the same rule or same principle to your personal? The answer is yes, but not necessary. So I believe, we have the answer already, right? So yes, you can apply the same rule, same principle to your personal financial. However, there's no sense to do it. There's no any sense because you don't issue the stock, you don't have any shareholder report to, you're responsible for yourself. The only basic purpose is you just want to make sure no overspend. So yes, you can use the same rule, same principle to manage your personal financial, but I think it's overreact. It's too much because you need to spend the time to prepare this, and you spend so much time, so much effort, so much energy. The result is so little, and you don't see too much benefit. So did I give you the answer? Yes, you can do it, but really depends on your purpose. If your personal financial situation is very complicated, okay, even without any responsibility to report to any authority, you just want to report to yourself, yes, definitely you can do it. You can do it. Okay. The question is whether or not it's worth it. If you think it's worth it, you can do it. Go back to my example here. All right. So this is one of a very simple example for any one of you. If you ever thought about to start your own business, doesn't matter how small it is. Usually this is step number one. Step number one. You transfer your personal assets, maybe cash, to your business. I just give you another example, similar one. Okay. Say for example, this time you don't transfer cash. You just transfer your notebook computer. Eventually we talk about this idea last semester when we talk about taxation, when we talk about tax. When you use your personal computer for your personal use, there's no any tax benefit. You pay say $500 for the notebook. You use it for your personal. There's no any tax benefit for it. However, if any day you decided to transfer this same computer, same usage, same thing, however, you transfer your computer to your business, then tax benefit happen. So for my old student, you took my taxation class, still remember what's the benefit? You transfer your personal computer to your business use. What's the benefit? What's the tax benefit for that? Deduction. You can deduct this $500 you pay for a computer. You deduct this $500 from your business income. Without transfer to business, you cannot deduct $500 on your 1040. 1040 means tax. You cannot deduct, say, oh, I pay $500 for my business. No, for my notebook computer. And if this notebook computer is only for your personal, doesn't matter how much you use it. You cannot deduct this $500 from your personal income tax. However, anytime, any day, you decide, you can make a decision. Say, I will transfer this computer, okay, to my business, and from that moment on, for your business, not for your personal, okay, for your business, you can deduct this $500, hopefully all of them, from your business income. So you see, you are taking tax benefit. So that's why I offer those 3 courses. So for those of you are new, so for at least for my courses, you need to take total 12. I offer 3, okay? 25%. The reason why I design my course, okay, I have a financial accounting for this course, and next semester, business law. Easier, okay, easier than this course. At least you need to know what's the legal issue related to your business. And next one is the taxation. They are all related to each other. Hopefully, they are helpful for your own business. So, for example, you transfer $500 value notebook computer from your personal to business. Tell me, what's here? Assets, equipment. Even though there's not cash, equipment, business equipment is under the assets, right? And another 500 is here. Equity. Same thing, very similar. Very similar. So remember, right now we are talking about 3 elements. That's all. 3 elements for business, for balance sheet. Assets A equal to L, liability plus E. So see, 200 equal to 200. Right. But we are not finished yet. We are not finished yet. There are 2 more elements. So total there are 5 elements for you to remember. That's all. 5 elements. Good deal, right? Very good deal for you to take this class, right? Another two elements. They are under income statement. Income statement is one basic financial report to tell everybody to see whether or not this business is making profit or incur loss. So my last question is, even without any financial accounting background or knowledge, there are 2 elements on the income statement. What are those 2 elements?
Revenue, expenses.
I want to give an opportunity to these people, okay? To their people. Anybody to tell me?
Revenue.
Right, revenue. Right, number 1 is revenue. And the other one? Expenses. So, ta-da, we finished for this semester already, right? Total 5 elements you need to remember. So it doesn't matter how complicated you can make this course. Okay, how complicated you can make this course is. 5 elements. As long as you remember these 5 elements, I think for your whole life you won't forget what is balance sheet and what is income statement. I don't really care about cash flow statement. I don't really care about return earning. That's for a very big company. Unless you really want to go into accounting business, you want to find a job, okay, as an accounting. Otherwise, I don't really care about that. Okay, but if you really want to take the CPA, then you need to be serious. Otherwise, for 99% of my students in this classroom, good enough. You can read. You learn how to read, how to analyze, okay, how to analyze the business. All right. So, say for example, if people tell you ABC company just sold $1,000 merchandise to XYZ company. All right? Very short message like this. Okay? ABC company just sold 1,000 value merchandise to XYZ and 30 days payment. 30 days payment. Without any accounting background, okay? Assuming you never learn accounting. This short message tell you how many accounts affected. How many accounts? So total 5 accounts, right? Assets, liability, equity, revenue, expenses. Oh, by the way, when we say expenses, in broader sense, including cost of goods sold, they are different, by the way, okay? Expenses is different from cost. However, when we talk about expenses in broader sense, broad way, they're including cost. So just give you this hint. Okay, ABC company just sold 1,000 value merchandise to XYZ, but payment term is 30 days. How many accounts affected here? So one by one. My suggest, every time when you read one questions or information, if this information involves cash, we always pick up cash first. Okay, then make the other list. Okay. So ABC company sold 1,000 value merchandise to XYZ company. Let me ask you the first questions. Does cash involve here?
Yeah.
No.
To answer. No cash involved. There's no cash involved. Because I told you, right? Payment term is 30 days. So that is a temptation. Whenever we hear about dollar sign, dollar sign, we throw cash. No, that's not true. When people talk about how much money, right? Do not jump to cash first, especially when you learn this course. When people talk about, wow, couple of $1 million. When we hear about dollar sign not necessarily mean cash. Here, ABC company sold 1,000 value merchandise to XY company, but I said 30 days payment term. Oh, you're alert, right? You're alert. Oh, no, there's no cash. There's no cash. So there's no cash, okay? So what is the first item you want to pick?
Access.
Assets. Which assets?
Account receivable. Account receivable.
Yes, account receivable. Because your company does not receive cash. However, you incurred account receivable, and account receivable is valuable assets, even though it is not cash right now. But assuming XYZ company is credible, very reliable customer, they're gonna pay you around 30 days. So number one is account receivable. So we have account receivable here. The other one? Inventory. Inventory is another asset, right? Inventory is another asset, but inventory reduced, right? Right? The problem is inventory usually is not reduced by 1,000. Got the point? You are running the business, right? Usually you don't sell inventory as the price, right? Otherwise you make nothing. Understand? So reasonably, the amount on the inventory reasonably should be less than 1,000. So right, you pick up the right account. Inventory got affected, but usually as a business, for the normal business, you will not say your 1,000 inventory as 1,000 sales unless something wrong happens, right? So right now we have one problem here. You pick up the right account, but the problem here already. This amount usually is less than, assuming 700, because your company must make some profit. Assuming that your inventory is 700. That means you ship out your inventory to your customer, but the value or the amount is not 1,000. Of course. Say assuming this inventory is 700. Then how can you make this balance or even? Where this
Profit.
300? Yeah. So even I have not finished yet. So he gave all the right answer, right? In order to keep the both sides balanced, right? Because this 700 is negative, so we have a 300 here. So we have to find something equal to 300 to make the whole thing still keep the same number, the balance, right? There's a 300, and this 300 usually is the profit, you know, is profit. And the profit go to equity. Equity. So I have 300 here, 300 here. So still make it good. Yes.
So you mean when you account for inventory, you account for its cost
Yes,
of
I will
goods
tell.
sold
I will
instead
give you
of
that example right away.
Okay.
Yeah, I will go into detail very soon. Very soon. So this is the basic idea. You see, oh, okay, when I read this information, ABC company just made a $1,000 sales, but no cash payment, 30 days, right? Then at least a few accounts affected. So account receivable, inventory, but whoops, not balanced. If it is balanced, it's okay, no profit, no loss. But usually there is profit there. So where profit go to owner. Profit go to owner. Alright? However, it is not that easy to reach this result. This is a result. I just tell you the result because assuming you are not going to the accounting field, you just want to read the result as a user, right? And this is a result. But for the accounting process, it's not that easy. This is jump to. We jump to the end already. We see the result already. But for the process, it's not that easy. Okay? For the process, it's like this. Okay? It's called key account. I need to erase this. For the whole process, we call this a T account. This is a T. It's called T account. For each items, we have T account. Remember 5 items, right? 5. We have 5 elements, right? Assets, liability, equity, revenue, and expenses, and sometimes cost, including in the expenses, right? Okay. For each element, we have T account. Eventually, for each items, just like she just asked me, right? For each items, we need to maintain T account. And for today, it is not really the T account. It is in your computer, QuickBook, whatsoever, right? In your software, the software create this for you already. All right? This is called T account. And for T account, you have the name of the item here. Say, for example, account receivable. On the left side, we give the name, say this is a credit side. But no any meaning, by the way. Credit, debit, no any meaning here, okay? Just only tell your credit side is on the left, debit side is on the right. That's all. And there is no any, any meaning on that. Alright? So for example, this account receivable. Right? Okay. So when we have the $1,000 sales, okay, account receivable, when we enter this $1,000, we do not connect this to inventory directly. Otherwise, the number does not match. Alright? Okay, let me put this way, okay. For any assets, this is in your book. I see this on the page. Doesn't matter. When you get a book, you will see this. Let me see. I believe this is chapter 2. Chapter 2 doesn't really depends on what kind of edition you use. Okay, I'm using 5th edition. I was told by my student, if you get a 5th edition, it's only $2. So if you pay more than $2, you pay too much. But for the 7th, for the current edition, it's very expensive. It's $130. So for this class, 5th edition, good enough. Okay. So in chapter 2 you can see 5 accounts here: assets, liability, equity, revenue, expenses on the page 57. Assuming you are using 5th edition. And then on page 63 is the same thing here. But without a book, even you don't have a book today, you can just write it down. For any assets items, if this account increase, you enter the number to the left. Okay? And for liability is opposite. Equity. For expense, let's have the upside down from here. At the first time you feel this is very strange, but once you get used to it, it's okay. Because here there's no any logic. You just write it down. Okay. Number 1, there's no logic as credit debit, because credit debit here mean nothing. Only tell you, say credit side is on the left, debit side is on the right. Then you just need to memorize for those 3 accounts, 2 accounts, assets, expenses, they are on the same side. So if you determine this item is assets, then if this item increase, you write it down the number to the left side. Okay. So for example, here, account receivable is assets, right? Then we have 1,000, right? So here is 1,000 here. Here, you write down on this side. Got it? However, you know you need to pick out another item which can match 1,000 on the right side, in debit side. So can anybody tell me which account you want to pick to match this transaction? To match. Don't talk about inventory, okay? We don't use inventory right now. Which item? Anybody else? Revenue. So right now we do not jump to inventory, not that quick, okay? We pick out revenue because this $1,000, yes, it is revenue, right? And you see, revenue is here. So this will tell you, well, in the first time it does not make any sense, but it is true. Otherwise, you cannot make the whole thing balance. So here we match revenue. Got it? So 1,000 on the credit side and 1,000 on the debit side. I want to make sure everybody follow me so far because everything should be very simple. But I know the only thing we may make you get confused is what's the credit, what's the debit. Just remember here, credit debit mean nothing. Only designate to left and the right. Okay, this is number 1. And number 2, more importantly, you need to memorize. Okay, if this item is assets or expense item, increase on the left, decrease on the right. And the opposite, if this item is liability or equity or revenue, increase on the right, decrease on the left. And number 3, every time you enter one account, you must find out another account or another 2 accounts to match the same number on the opposite side. That's all. So that is the reason why when you enter the account receivable, you cannot pick out the inventory. You don't jump to inventory. those two accounts do not match together. So that is the reason why when you pick up account receivable assets, at this moment you need to match revenue, because the revenue is exactly the same amount, $1,000. I want to make sure so far so good. Alright, then we go to next step. How do we handle the inventory? How do we handle the inventory? Okay, assuming we just plug here. Inventory. So inventory, we know that is one of the assets, right? Right? So as I said, the rule I just told you, right? When inventory decrease, right? Inventory decrease, right? Because you ship out, right? You ship out, so you deduct your inventory, right? So when inventory reduce, we have this side, right? Right? Then, what is the other account you want to match? You think about that. What is the other account I want to figure out that? And it's $700 on the left side to match this part balance. Which your account? Yeah. You can say expenses, but more precisely, you should say cost of goods sold. Cost of goods sold. Okay. You can say cost. Okay. But I say for this moment, you say you think about cost is expenses is okay. But for the more detailed thing, expenses is not really the cost. But right now, at this moment, we just say it's the same thing. Okay. So. Cost of goods sold. Here. Cost of goods sold. Your cost is exactly this amount, the value on the inventory. Okay? So right now we make this part also balanced. 700 on the right, 700 on the left, also balanced. And then you don't have to worry about profit or loss. Right now you don't need to worry about that, because by the end of the period, you will see you have a revenue 1,000. Revenue appear on your income statement. You have $700 under your either expenses or cost. So for this transaction, you already see $300 as profit. As profit. Got it? Eventually, when we talk about income statement, the whole structure is like this. Okay. Revenue. We have one chapter to talk about this. Okay. Cost first, minus cost and minus expenses. This is simplified. Okay. Doesn't matter how complicated, doesn't matter how large the company, the business is. Usually when you see the income statement, okay, it is a revenue, deduct cost first. And some people say this number is gross profit. If you heard about gross profit, that means is before expenses. Okay. So revenue deduct the cost of goods sold. This number here, some people say there's a gross profit. Or you can jump to, without this number, directly jump to expenses, you receive net profit. Some people say this is a profit before tax.
Can the company to the cost?
Say it again.
Can the company to the cost?
Very good questions. Let me repeat his questions. Okay.